Hi there, tax accountants. I hope all is well, and I pray that as you are viewing this video, that you are in the best of health and spirit. This video will cover several questions from Pearson's Federal Income Taxation from Chapter 1, which covers an introduction to taxation, and Chapter 2, which covers the determination of tax. So we start off with our first question, and just a rule of thumb, anytime you are either taking an exam, preparing for homework, it always makes sense to read the last sentence first. That ultimately lets you know what the question is asking for. So therefore, you know which information is relevant. So here we look at this question and it states, the amendment to the US Constitution allowing the imposition of a federal income tax is the. So then we go back and we read the full problem. So it says, until about 100 years ago, attempts to impose a federal income tax were ruled unconstitutional. The amendment to the US Constitution allowing the imposition of a federal income tax is the blank. So as we know, federal income taxes, they have a significant impact on businesses, investors, as well as personal decisions that persons make in the United States of America. So with the federal income tax, it's essentially a dominant form of taxation in the United States. Some states and some cities, they also impose an income tax. And corporations as well as individuals are subjected to taxes. All right, so we learned that in Chapter 1. So the first form of income tax was enacted in 1861, and this was essentially to finance the Civil War. But after the war ended, income taxes were repealed. However, 33 later, in 1894, they reinstated the federal income tax. However, they found it challenging. Reason being is because an individual was required to pay taxes based on the state that they lived in, their state of residence. So they essentially found it to be impractical and it was difficult to administer. So in 1895, the Supreme Court ruled that the taxation on individuals was in violation of the US Constitution because, again, it became very difficult. It was impractical to administer taxing individuals based on the states and the residents. However, in 1913, the 16th Amendment was ratified. And what essentially happened is that with the 16th Amendment, it's one sentence, and it basically gives the government the ability to tax individuals. And the 16th Amendment to the Constitution of the United States states the following: the Congress shall have the power to lay and collect taxes on incomes from whatever source derived, without apportionment among the several states and without regard to any census or enumeration. So simply stated, all persons are subjected to federal income taxes. Of course, there are some nuances regarding who needs to file, but at the very least, individuals as well as businesses are subjected to federal income taxes. And depending on where you live, you might or might not be subjected to state income taxes. So the correct answer for question 1 is the 16th Amendment. Our next question brings us to learning objective 1.2. And we're dealing with the types of tax rate structures. So virtually all tax structures are comprised of two basic parts. We have what's called the tax base, and we have what's called the tax rate. So the tax base is basically just the amount to which the tax rate is going to be applied in order to determine the tax that is due. For individual income taxes, the individual tax base is the taxable income, and then from there, we simply multiply based on the progressive rate, as we'll learn. So here it asks us, discuss the position of the congressman giving consideration to tax rate structures, progressive, proportional, and regressive in the concept of equity. So it states, Congressman Patrick indicates that he is opposed to tax proposals that call for a flat tax rate because the structure would not tax those individuals who have the ability to pay. Discuss the position of the congressman giving consideration to the tax rate structures, progressive, proportional, and regressive in the concept of So tax rates may be progressive, proportional, or regressive. So a progressive tax rate structure, that's essentially one where the rate of tax increases as the tax base increases. So the most notable tax that has a progressive rate structure is the federal income tax. So there's essentially 7 tax rates. It starts at 10%, 12%, 22, 24, 32, 35, and 37%. So essentially, as a taxpayer's taxable income increases, so does their marginal tax rate. So the taxpayer's marginal tax rate is the tax rate applied to an incremental amount of their taxable income. Next, we have what's called a proportional rate. This is considered a flat tax. So this is one where the rate of tax is the same for all taxpayers with no regard to their tax base, right? So this type of tax rate, sometimes it can be used for real estate taxes, state and local sales taxes, personal property taxes, custom duties, excise taxes. So with the flat tax, again, it does not matter your income level. Everyone is subjected to these taxes. And then we have what's called a regressive tax. And with regressive taxes, the tax rate decreases with an increase in the tax base. So a great example of this is Social Security, FICA taxes. It's considered a regressive because old age survivors disability insurance, referred to as OASDI, it's taxed at a flat 6.2%. And then once an individual pays taxes on the maximum amount, they no longer need to pay that 6.2%. And that applies to both the employee and the employer. So this brings us to the question. Under a blank tax rate structure, the tax rate increases as the taxpayer's income increases. So based on what we just discussed, here we have progressive, proportional, regressive. So we know with progressive, and we can think of the terminology in and of itself. Progressive means to essentially increase, increase. So in this case, we have progressive, we have proportional, which we know is flat, and then we have regressive, which basically means that there's a decrease. So in such case, under a progressive tax rate structure, the tax rate increases as the taxpayer's income increases. It says under a blank tax rate or blank tax structure, the same rate applies to all taxpayers regardless of their income levels. So under a proportional tax rate, or sometimes it's also referred to, here we see average, we see effective, we see flat, and we see marginal. So just to ensure that you understand what these means. So the average tax rate, this is essentially computed by dividing the total tax liability by the amount of the taxable income. So let's say we have an example here. The individual, let's just say that their tax liability was $146,895. So this represents their tax liability that they have to pay to Uncle Sam. And their total taxable income for the year was $500,000. Based on this information, their average tax rate is 29.4% rounded. All right. So when it comes to the average tax rate, we divide the total tax liability by the amount of the taxable income. Next, we have the effective tax rate. So the effective tax rate, that is essentially the total tax liability divided by the total economic income. So total economic income, it essentially includes all type of economic income that a taxpayer has for the year. So this is much broader than taxable income, and it also includes most types of excludable income. So as we'll learn in chapter 4, there are some provisions in the tax code that allows certain income to be excluded. But as we consider the effective tax rate, it includes most excludable types of income. So as it relates to the basic purpose of calculating the effective tax rate, it basically provides a measure of the taxpayer's ability to pay taxes. Next, we have a flat tax rate, and that is our correct answer. The proportional tax rate, it's flat. It does not matter the person's income tax base, where they live, how much they earn. It's a flat rate that everyone is subjected to. And then lastly, we have the marginal tax rate. And a marginal tax rate is the tax rate that is applied to an incremental amount of taxable income that is added to the tax base. So simply stated, depending on how much income a person earns, that ultimately determines what their marginal tax rate will be. So think of it as buckets, right? So we essentially have the 7 tax brackets, and depending on how much income you earn, once you fall within a certain bracket, then there is a specific amount of income that is going to be taxed in each bucket. So just to give you guys a quick visualization, so that way you understand. So here we have a quick example. So we have single, we have married filing jointly, and we have head of household. As we know, there are 5 different filing statuses, but just for purposes of you gaining a better understanding. So let's say that we're dealing with a single individual and their income is $40,000 even. The taxable income is $40,000. So for the first $11,000 that single individual earns, it will be taxed at 10%. And keep in mind, they earned $40,000. So therefore, of the $40,000 that they've earned, $11,000 would be taxed at 10%, and the remaining $29,000 will be taxed at 12%. So oftentimes persons think that they are subjected to a flat rate. That is not how it works. Think of it as buckets, okay? So let's just say that instead, this individual's taxable income is $50,000. We're still dealing with a single individual. So for this single individual, their taxable income is $50,000. Of the first $11,000 that they earned, it would be subjected to a 10% tax bracket. And then the amount that they earn between $11,000 to $44,725, that amount will be subjected to 12%. And then the amount that they earn above $44,726, they will be taxed at 22%. So for this single taxpayer, their marginal tax rate is 22%. So therefore, for every dollar that they earn, keep in mind, as of right now, their taxable income is $50,000. But even if they earn $55,000, they still fall within this 22% range up until they earn $95,375. So therefore, this single taxpayer, their marginal tax rate is 22%. So for every dollar that they earn above $50,000, they will need to pay 22 cents per dollar. All right, so this is to provide you with a visualization of the marginal tax rate. But again, back to the question, under a proportional tax rate or flat tax structure, the same tax rate applies to all taxpayers, regardless of their income levels. Lastly, we have under a blank tax rate structure, the tax rate decreases with an increased income level. So the correct answer is under a regressive tax rate structure, the tax rate decreases with an increase in income level. So the next part of the question asks, the concept of blank equity holds that taxpayers with blank income levels should pay a higher proportion of tax, and that the tax should be borne by those who have the ability to pay. So based on this information, there's this concept of vertical equity. And with the vertical equity, that essentially holds that individuals that have higher income levels, that they should pay a higher proportion of their income. So oftentimes there's a lot of conflict with policymakers and things of that nature because they feel as though taxes just are not fair. So these are one of the things that are essentially discussed. So establishing a criteria for a good tax structure was first attempted in 1776 by an economist named Adam Smith. So Smith had 4 canons of taxation. He believes that taxation should be equity, there should be certainty, there should be convenience, and there should be economy. And many have added a 5th canon of simplicity. So as it relates to equity, it's a rather obvious criteria that a good tax structure should be equitable or fair to taxpayers. However, unfortunately, what might be considered fair to one person is not considered fair to another. So unfortunately, fairness and equity is considered relative in nature and obviously can be difficult to measure. So a great example is that as it relates to itemized deductions, someone who owns a home, mortgage interest is considered deductible. However, if someone rents, no portion of their rental, expenses that are being paid are considered deductible. So if you are a homeowner, it's a benefit. But if you are renting and you don't own a home, then you don't find that fair, right? So that would be an example. So two aspects of equity are commonly discussed in tax policy, and it's called horizontal and vertical equity. So horizontal equity, that refers to the notion that similarly situated taxpayers should be treated equally. However, vertical equity, on the other hand, implies that taxpayers who are not similarly situated should be treated differently. So based on this information, the concept of vertical equity holds that taxpayers with higher income levels, they should pay a higher proportion of tax, and that the tax should be borne by those who have the ability to pay. So with the vertical equity tax, that would essentially be, let's say we have taxpayer A and we have taxpayer B. If taxpayer A has income of $100,000 and taxpayer B has income of $30,000, taxpayer A and B, they should not pay the same amount of income tax. But on the other hand, Congressman Patrick's opposition to the flat tax philosophy is considered correct, right? So he indicates that he does not think that there should be a flat tax rate because it would not have a benefit to those who have the ability to pay the tax. All right, so this brings us to our next question. So here it asks, property taxes are primarily used by, so it says, for each of the types of taxes below, discuss which level of government primarily uses that type of tax. So the three different levels of government, federal, state, and local, must impose taxes to carry out their functions. For each of the types of taxes below, discuss which level of government primarily uses that type of tax. So we have property taxes, excise taxes, sales taxes, income taxes, as well as employment taxes. So for property taxes are essentially based on the value of a taxpayer's property. And this might include real estate as well as personal property. So real estate taxes are a major source of revenue for local governments. In addition, sometimes some state and local governments, they might levy a personal property tax on intangible items. So quick side note, tangible items are things that you can see, you can touch, you can feel. Intangible items, on the other hand, are items that you cannot physically touch, see, and feel, but they have value, all right? So an intangible item might be securities, stocks, bonds, things of that nature. They have value, but you can't necessarily see them or touch them. Tangible personal property, on the other hand, might be a personal automobile. We can see the car, we can touch the car. So the correct answer for A is that property taxes are primarily used by the local government, and they are imposed on items such as alcohol, tobacco, telephone usage, and other goods. No. Constitute a major revenue source? Seems like this could be a correct answer, but we always want to choose the best answer. Include both real property taxes and personal property taxes. So the correct answer is includes both real property taxes and personal property taxes. So this brings us to B. Excise taxes are primarily used by blank and. So excise taxes and custom duties, these are essentially taxed on imported goods. So it generally declined in importance over the years, but they still remain a significant source of revenue. So federal excise taxes, they're imposed on things like alcohol, tobacco, gasoline, production of oil and gas, and other types of goods. So many state and local governments, they impose similar excise taxes on goods and services, but for the most part, they are primarily used by the federal government, and they are imposed on items such as alcohol, tobacco, telephone usage, and other goods. So next we have C, we have sales tax. So sales tax is a major source of revenue for state and local governments. So sales tax, they're imposed on retail sale of tangible personal property. So if you're purchasing a vehicle or if you purchase clothing, some states also impose a sales tax on personal services. So if you provide accounting and legal fees, certain items, they are exempted from sales tax. So this might include certain food items, medicines, and the rates, they basically vary based on the individual state and local government. So just keep that in mind. And as it relates to sales tax, they're generally not deductible for federal income taxes. But, if you have a business, then in such case, they are considered deductible if it's incurred in a trade or business. And just another quick side note, as it relates to itemized deductions, a taxpayer can decide to deduct state and local sales taxes if they elect to deduct them instead of deducting their state and local income taxes that are withheld from their job or that are paid via estimated taxes. So sales taxes are primarily used by state and local governments, and they constitute a major revenue source. This brings us to D, income taxes. As we know, our income taxes are the primary domain of both the federal and the state government. And they constitute a major revenue source. And for E, we have employment taxes. So employment taxes include Social Security, FICA, and federal and state unemployment compensation taxes. So if an employee is considered if an individual rather is considered an employee, then FICA taxes is imposed for both the employee and the employer. So employment taxes are primarily used by federal and state governments and constitute a major source of revenue. All right, so this brings us to our next question. So here we see two commonly recognized measures of the fairness of an income tax structure are horizontal equity and vertical equity. So we discussed this not too long ago, right? And again, based on the 4 or 5 canons as it relates to a good tax structure, it should be, there should be equity. There should essentially be equity. It should be considered fair. There should be compliance. It should essentially be easy to administer. So there's certain things to keep in mind as it relates to the criteria for a good structure: equity, certainty, convenience, economy, and then it should be simple. So this deals with equity, right? And as we mentioned, sometimes some individuals, they believe that there should be vertical equity. And what that basically means is the individual who is not in a similar situation, they should be treated differently. If taxpayer A earns $100,000 and taxpayer B earns $30,000, taxpayer A who earns $100,000 should pay more in taxes. With horizontal equity, then that refers to each individual should be treated equally. So even though taxpayer A earns $100,000 and taxpayer B earns $30,000, they should pay the same amount of tax. So here it asks, discuss what is meant by horizontal equity and vertical equity as it pertains to the income tax. B, why is it so difficult to design a fair tax structure? So two commonly recognized measures of the fairness of an income tax structure are horizontal equity and vertical equity. So we have A and we have B. So blank equity refers to the concept that similarly situated taxpayers should pay approximately the same amount of tax. So we know this is horizontal tax. Blank equity refers to the concept that higher income taxpayers payers should pay a blank amount of tax and a blank percentage of tax. So vertical equity refers to the concept that higher income taxpayers should pay a higher amount of tax and a higher percentage of tax. Blank equity is based on a notion that taxpayers who have the ability to pay should pay blank tax than lower income taxpayers. So this is vertical. So vertical equity is based on a notion that taxpayers who have the ability to pay should pay more than lower income taxpayers. So B asks, why is it so difficult to design a fair tax structure? So again, as we mentioned, in a previous question, fairness is relative, right? It ultimately depends on the person. So if we were to think of that situation that I gave previously, mortgage interest being deductible for a homeowner, however, an individual who does not own a home and they rent, however, none of their rental expenses are considered deductible, the person who rents might not find it fair, but the person who owns a home does find it fair. So unfortunately, fairness is relative in nature, and obviously it's difficult to measure. So here, for A, we'll go through each answer choice. A says fairness is relatively simple to measure. It is difficult to design a fair tax structure because the federal and state governments have concerns that tax revenues will decline significantly using a fair tax structure. The last sentence seems fine, but the first sentence is incorrect. It says fairness is relatively simple to measure. That's definitely not true, so we can cross out A. B states fairness is relative in nature and is extremely difficult to measure. That is true. It says what one person may conclude is fair in a particular situation may be considered totally unfair by another person. That's true. Seems like a great answer, but we'll go through the others. It is difficult to design a fair tax structure because federal, state, and local governments have differing opinions on how to design a structure. All right, seems like a fair answer. Fairness is very objective in nature and easy to measure. The difficulty in designing a fair tax structure comes from the fact that revenues will decline significantly using a fair tax structure. So the first sentence is incorrect. So that leaves us with C, and that leaves us with B. So correct, federal, state, and local governments, they do have differing opinions, but the key thing is ultimately the fairness is based on the taxpayer. So the correct answer is B. Fairness is relative and extremely difficult to measure, and what one person concludes is fair, again, the person who rents versus the person who owns a home, it ultimately depends on the individual. So B is our correct answer. So this brings us to our next question. So it asks, distinguish between tax-paying entities and flow-through entities from the standpoint of the federal income tax law. So the federal income tax law levies taxes on taxpayers. But one key thing to keep in mind is that not all entities that file an income tax return actually have to pay tax, right? So based on this information, there's various entities in the federal income tax system, and they are classified into two general categories. So we have what's called tax-paying entities, and we have what's called flow-through entities. So tax-paying entities, they're generally required to pay income taxes on their taxable income. And then we have flow-through entities, which are also referred to as pass-through entities. And these, on the other hand, they do not directly pay taxes, but essentially they pass through, they flow the income through to a tax-paying entity. So the major entities for tax-paying entities, this includes individuals, and C, corporations, which are also referred to as regular corporations that are governed by subchapter C, as in CAT, of the Internal Revenue Code. And then some examples of flow-through, AKA pass-through entities, or sole proprietorships. They file Form Schedule C. Partnerships, they file Form 1065. S corporations, they file Form 1120S as in Sam. We have LLCs. An LLC can be a single member LLC, which is treated as a disregarded entity and files Schedule C. Or we can have a multi-member LLC. They are treated as a partnership and they can file Form 1065 unless they make an election. And then there's also LLPs, limited liability partnerships. They file Form 1065, as well as trusts and estates. So here it asks, blank entities such as blank are required to pay income taxes on their taxable income. So tax-paying entities, such as individuals and C corporations, correct. But let's look at the other options. Individuals and S corporations, incorrect. S corporations are flow-through entities. Sole proprietorships, partnerships, and C corporations and certain trusts. This is incorrect because a C corporation is a tax-paying entity. Sole proprietorships, partnerships, S corporations, LLCs, LLPs, and certain trusts. This is incorrect because they are considered flow-through, aka pass-through entities. So the correct answer is individuals and C corporations. So next we have blank entities such as blank generally do not directly pay income taxes on their taxable income, but merely pass the income on to a blank entity. So the correct answer is flow-through entities such as sole proprietorships, partnerships, S corporations, LLCs, LLPs, and certain trusts. They generally do not pay income taxes on their taxable income, but they merely pass it on to a tax-paying. All right, this brings us to our next question. And here it states the profession of tax practice involves 4 principal areas of activity. Discuss these 4 areas. So it says select the 4 areas of practice and a description of each. So the tax practice is obviously rapidly growing, right? And it provides substantial opportunities for tax specialists. And this is in public accounting, in law, and in industry. So the tasks that are performed by a tax professional, they can range. They can simply just prepare a Form 1040 for an individual. They can perform tax preparation services for a business. They can also do some tax research, some tax planning for highly complex individual or business tax situations. So tax practice can consist of the following activities. So here we have tax compliance and procedures. This is the most basic. And a description of this is that they argue for a refund or settlement from the IRS. No. They assist clients with planning for all of their financial affairs. No. The process of developing the most defensively correct solution to a problem. Process of reducing taxes so as to maximize the taxpayer's after-tax return. No. Proposal to allow the tax system to work better. No. Tax return preparation and assisting the taxpayer with dealing with the IRS. So this is the area of practice. Tax compliance and procedure. So preparation of tax returns is a significant component of a tax practice. So tax practitioners, they often prepare federal, state, and local tax returns, not just for individuals, but also for corporations, estates, trusts, and etc. So if you're dealing with a larger corporation, sometimes the tax return preparation, which makes up the compliance function, is usually performed by the internal tax department. So this is a very important part of a tax practice, assisting clients with dealing with the IRS in the event that, let's just say, there's an audit or something of that nature, and also assisting them with preparing their tax returns. So another area of a tax practice, and again, we're looking at the 4 areas of practice, is tax research, right? So virtually every transaction that takes place, it potentially has a tax implication. So you need to be able to know how to navigate and understand and apply the intricacies of tax law. For example, I have a client, they have a rental property and they were considering selling the rental property. So they reached out to me, they asked me several questions to determine whether or not it would make sense to sell the property now or if they should wait. So based on my research and based on my conversation with the client, based on their income, obviously there's a myriad of factors. So based on our conversation, it made sense for them to wait because they didn't have the property for more than a year. So therefore, it would have been a short-term gain, which would be taxed at ordinary income tax rates. But based on their income, if they wait and hold the property for more than a year, then because it's a long-term capital gain, it would be subjected to zero taxes, right? So this can be both an example of tax research and tax planning. So they essentially work hand in hand. So with tax research, this is essentially the process of developing the most defensively correct solution to a tax problem. All right. So with tax research, this essentially involves, a completed transaction or a proposed transaction. So with a completed transaction, this is if they already sold the property, right? If they didn't decide to consult with me and they just sold the property, that's a completed transaction. It already happened. Versus a proposed transaction where they were considering selling it, but they essentially came to me first. So as it relates to tax research, we determine the facts, identify the issues, identify and analyze the tax law sources, evaluate the implications, and then I communicated the findings to the client. And then from there, they basically made the decision. So again, this ties hand in hand with the next area of practice, which is tax planning. So tax planning, this basically involves the process of structuring one's affairs to minimize the amount of taxes and maximize the after-tax return. So tax planning is essentially not just to pay the least amount of tax, but to maximize the after-tax cash flows, right? So definitely want to make sure that you're helping a client to optimize their tax situation. So especially dealing with business owners, right? If you're an employee, there's not a lot of wiggle room, but for individuals who are business owners or they're self-employed, there's lots of little things that essentially can be done to apply the tax law to be able to ensure that they are getting the best benefit of their situation. So as it relates to tax planning, this is the process of reducing taxes to maximize the taxpayer's after-tax return. So the last part of an area of practice can be financial planning. So as it relates to financial planning, this is an important field for tax professionals, right? Personal financial planning for your individual clients, and sometimes this also applies to businesses, not just individuals. So taxes are essentially an integral part of any financial plan. Reason being, as we know, all of us, everyone, individuals and corporations alike, are subjected to federal income taxes. So therefore, every decision that an individual makes has an potential tax implication. So with financial planning, this is essentially assisting clients with planning for all of their financial affairs. I have clients, sometimes they make withdrawals from their IRA, then there's a huge hefty penalty because they took it before their time, right? So there was no exception, and then clients are hit with a 10% penalty. Some clients were not aware, they didn't know, they didn't have enough income taxes withheld, and then next thing you know, there's a very large tax bill. So financial planning is definitely a key component of what tax planners do. All right, so just, ensuring that everyone understands with tax negotiations, this essentially falls under compliance and procedures. So this is if, let's just say, the IRS reaches out to a client for an audit or something of that nature, then you can negotiate. So this is a part of tax compliance and procedure. Tax reform, that's essentially, with the tax laws and things that are being passed, right? Tax laws, tax bills. That is essentially if you are in that realm of influence, but we are just speaking about a tax practice, right? A company that provides tax services to individuals. All right, so this brings us to chapter 2. So in chapter 2, we learn about the determination of tax. right? And each year, individuals file over 160 million federal income tax returns. And the tax is basically imposed on the taxable income for each individual. So as it relates to the amount of tax, their tax liability that's owed, it ultimately is dependent upon the taxpayer's taxable income and the tax liability. So essentially, we need to apply these complex set of rules. We know that there's a tax formula. So we take the time to study the basic formula on which the income tax computation is based. So one of the key things as it relates to determining what an individual's tax liability would be and whether or not they have a refund, we need to factor in, well, what is their filing status, right? Do they have any dependents? And in order to determine an individual's filing status and if they have any dependents, it is very important to be able to distinguish between qualifying children and qualifying relatives. So as it relates to qualifying children / qualifying relatives, so at the very least, qualifies that a dependent and individual must meet the definition of either a qualifying child or a qualifying relative. So for both types of dependents, they have to meet several requirements. First and foremost, they have to meet a citizenship test. They have to meet a separate return test. And no one else can claim them as a dependent, or they cannot claim anyone else as a dependent, right? So here we have this example. Select the requirements applicable to all dependents, qualifying children, and qualifying relatives. So as just mentioned, all dependents, they can't claim anyone else as a dependent. They must meet a citizenship test, and they must have gross income less than the amount of the standard deduction. No, that's not the tier 1 requirement. They must have a social security number reported on the taxpayer's return. No, that's not correct. Sometimes they can have an ITIN, ITIN, an individual taxpayer identification number. E, they cannot normally file a joint return. This is correct. They must meet a separate return test. And F, they must live with the taxpayer for more than 3 months in a year. This is incorrect, as we'll learn a little later. They need to have the same principle of both. They must have lived with the taxpayer for more than half of the year. So the correct answer is all dependents. A, cannot claim others as dependents. B, must meet a citizenship test. And E, cannot normally file a joint. So here it states, select the additional requirements that must be met in order to be a qualifying child. So qualifying children must. So as it relates to qualifying children, so the additional requirements must also be met. And that ultimately determines whether the dependent is a qualifying child or a qualifying relative. So as it relates to qualifying children, there are some additional requirements. So the additional requirements for a qualifying child is that there's a relationship test, an age test, an abode test, and a support test. So as it relates to the relationship test, eligible children includes their biological children, adopted, foster, stepchildren, as well as the taxpayer's siblings and any of the descendants of above. In the event that, let's just say, a child was adopted, they need to have been legally placed or were legally adopted. So an age test, they must be under the age of 19, or if they are under the age of 24, they must be a full-time student. And to be considered a full-time student, they need to carry a number of courses that the educational institutions consider as full-time, and they need to be in school for at least 5 months of the year. The abode test, as mentioned earlier, they need to live with the taxpayer for more than half of the year. And lastly, the support test, the qualifying child should not have provided more than 1/2 of his or her own support during the year. So the requirements are as follows. 4 requirements. Have gross income less than the amount of the standard deduction. No. Must not provide more than half of his or her own support. Correct. They must live with the taxpayer for more than half of the year. There's a nuance as it relates to children who are under the age of 24. If they are away at college, they are still considered to be living with the, at home. Obviously, the only reason they're not at home is because they're in college, but that's a bit of a nuance. Be the taxpayer's child or sibling or descendant of the taxpayer's child or sibling. This is correct. Live with the taxpayer for more than 3 months in the year. This is incorrect. It's more than half of the year. And they must be under age 19. A full-time student under age 24 are disabled. So these are the 4 requirements for a qualifying child. And lastly, we have for a qualifying relative. So the other type of dependent is a qualifying relative. And for a qualifying relative, they also have 4 requirements. And the 4 requirements are relationship test, gross income test, support test, and not a qualifying child test. So the relationship test for a qualifying relative is that qualifying relatives must either be related to the taxpayer or reside in the taxpayer's household for the entire year. So sometimes this, qualifying relative dependent, it can be kind of misleading because the individual who lives with the taxpayer doesn't actually have to be related to them. All right. As it relates to the gross income test. So for the gross income test, the individual for 2022, their gross income must be less than 4,400, and for 2023, their gross income must be less than 4,700. In addition, they can't, or they have to rather, receive more than half of his or her support from the taxpayer. And lastly, they can't be a qualifying child. So A, do they have to be related to the taxpayer or reside in the taxpayer's household for the entire year? Yes. They receive over 1/3 of their support from the taxpayer? No. They receive more than half of his or her support from the taxpayer? Correct. They live with the taxpayer for more than 6 months in a year? No. They need to reside in the taxpayer's household for the entire year. E, have gross income of less than 4,400, and for 2022, that amount is 4,400, and for 2023, that amount is 4,700. They must have gross income that is less than the amount of the standard deduction. That is incorrect. The threshold is 4,400 for 2022 and 4,700 for 2023, and they cannot be a qualifying child. All right. So this brings us into some of the practical application of taxation. So a lot of the questions that we previously just referred to, they were theoretical in nature, but now we are going to start to look at some practical questions, actually applying some of the tax law to get a better understanding. So we're going to get an Excel spreadsheet. And as we go through the information, we're going to use both the 2023 and the 2022 tax year so we can get a greater understanding. So we'll start off with our first question. So here it says, for requirement A, compute their taxable incomes if they file separately, and Caitlin claims itemized deductions on her return. So it says, Caitlin has $61,000 of salary and $12,450 of itemized deductions. Caitlin has $93,000 of salary and $17,150 of itemized deductions. They are married and under the age of 65. So it's asking, compute their taxable incomes if they were to file separately. So we'll start off with the first person. Here we have Caitlin. And in this case, their adjusted gross income We start off with Caden. It lets us know that he has $61,000 worth of salary. It doesn't tell us that he has any exclusions or anything of that nature, so there's nothing for us to deduct. So Caden's adjusted gross income is $61,000 his salary, and it lets us know that he has itemized deductions of $12,450. So in such case, the total taxable income is $48,550. So if we compare it to the standard deduction amounts, we see this is for 2022, and then we'll also look at 2023. So for a married individual filing a separate tax return for 2022, the amount is $12,950, and for 2023, the amount is $13,850, right? But one of the key things when you are filing a married filing separate tax return, both spouses need to claim the same thing as it relates to from AGI deductions. They both either claim the standard deduction or they both claim the itemized deductions. All right. So in this case, because Caden is claiming itemized deductions, Caitlin also must file the itemized deductions. So they both essentially need to file the same thing. So there's a lot of nuance as it relates to filing a married filing separate return. You definitely need to do some tax planning to ensure that it makes the most sense and it'll work best in both parties' favor to file a separate return, right? And some people don't care, they just want to file separate. All right, but in this case, we're looking at Caitlin. Caitlin has a salary of $93,000. Her itemized deductions are $17,150. So therefore, in Caitlin's case, taxable income is $75,850. So if we were looking at 2023, the amounts would essentially be the same. Their income remains the same. But what does have an impact is whether or not their itemized deductions are actually greater. So here we see for Caden, 61,000. There's itemized deductions of 17,150, which brings taxable income of 48,550. Oh, sorry, I put the wrong amount. 12,450. 48,550. All right, and then now we look for Caitlin, salary of 93,000. We subtract the itemized deductions of 17,150. And her taxable income is 75,850. Make sure I have it correct. Caitlin's adjusted income, 93,000, 17,150. My apologies, I'm inputting the wrong amounts. 75,850. 93,000, 75,850. Perfect. All right. So for requirement B, it says compute their taxable income if they file jointly. Assume their total itemized deductions equals the sum of their separate itemized deductions. So we start off with their adjusted gross income. And in such case, it's 61,000 for Caden plus 93,000 for Caden. So that gives us an adjusted gross income of 154,000. So now we compare itemized deductions of 12,450 plus 17,000. And we'll do it here actually. 17,000 or 12,450 plus 17,150. So the total itemized deduction is 29,600. So we view the standard deduction amounts. So for married individuals filing joint returns and surviving spouses, in such case, it's 25,900. So keep in mind, to determine the taxable income, we take the greater of the two. So in such case, if we compare these amounts, the greater of the two is 29,600. And let's say that we were comparing it to, so itemized deductions, standard deduction. All right. So for 2022, the standard deduction was 25,900. And for 2023, the standard deduction is 27,700. So if we compare it for both years, in both years, it works better in their favor if they claim itemized deductions. So in such case, because the itemized deductions are greater for both years, the client will claim itemized deductions because obviously, and remember, when you think of the standard deduction, think of it as an amount of money that the IRS allows you to keep tax-free. So if you were a taxpayer, would you prefer to keep $29,600 tax-free? Or would you prefer to take $25,900 or $27,700? It works better in your favor to have $29,600 tax-free. So under 2022 rules, it would be the adjusted gross income minus the 29,600. And it would essentially be the same thing under 2023 because the itemized deductions exceeds the standard deduction for both years. So we would minus the itemized deductions of 29,600. So in this case, the taxable income would be 124,400. All right. So this brings us to our next question. So this question is essentially dealing with dependents, right? Very, very important to be able to clearly distinguish between who is a dependent and who is not. So it says, for each situation, determine whether the individuals qualify as Wes and Tina's dependents. So it says, Wes and Tina are a married couple and provide financial assistance to several persons during the current year. In all of the situations below, assume that any dependency tests not mentioned have been met. So it says, for each situation, determine whether they qualify as their dependents. So here we see Brian is age 24, and he's Wes and Tina's son. He's a full-time student, and he lives in an apartment near campus. Wes and Tina provide over 50% of his support. Brian works as a waiter, and he earned $5,200. So the reason why this doesn't qualify, all right, Brian, how old is he? He's age 24. So as we previously learned, one of the key things is that a dependent must be under the age of 19. And if they are above the age of 19, they must be in school full time and they must be under the age of 24. So because of this, Brian, he's age 24, he is over age 23, and based on his income, he earned $5,200. So for 2022, that income amount was $4,400, and for 2023, $4,700. So because of how much income he earned, Brian may not be claimed as a dependent because Wes and Tina do not provide 100% of his support. No, that's not the reason. Brian may not be claimed as a dependent. Brian is not a qualifying child because he fails the age test, correct? He's over 23. And he is not a qualifying relative because he fails the gross income test. His gross income was $5,200 is not less than $4,400 for 2022 and $4,700 for 2023. So this seems to be the correct answer. C, it states Brian may be claimed as a dependent because although his gross income exceeds $4,400, he's considered a qualifying child because he is a full-time student. Incorrect. The student has to be under the age of 24. D, Brian may be claimed as a dependent. Although his gross income exceeds $4,400, he is considered a qualifying relative because he meets the gross income test, and Wes and Tina provide over 50% of his support. D is incorrect. He earns more than 4,400, which is the threshold for 2022, and he earns more than 4,700, which is the threshold for 2023. So therefore, B is our correct answer. So for requirement B, it says, same as part A, except that Brian is a part-time student. So it says, Wes and Tina may claim Brian as a dependent in this case. Brian's part-time student status qualifies him as a qualifying relative. This is incorrect, right? Let's say he was 23 years old or 22 years old. You need to be in school full-time for at least 5 months of the year. So A is incorrect. B, although Brian's part-time student status makes him a qualifying child, he may not be claimed as a dependent because Wes and Tina do not provide 100% of his support. This is incorrect. Being a part-time student does not make him a qualifying child, and Wes and Tina need to provide over 50% of his support, not 100%. C, Wes and Tina may not claim Brian as a dependent in this case. Brian's student status is irrelevant because he is over age 23, correct? He's over age 23, therefore he's not a qualifying child. He also fails the gross income test, and so he's not a qualifying relative. C seems to be the correct answer. And D, Wes and Tina may claim Brian as a dependent in this case. Brian's part-time status makes him exempt from the gross income test. This is incorrect. Again, the requirement is that the child is above the age of 19, under the age of 24, and they're in school full-time for at least 5 months of the year. So C is our correct answer. So for requirement C, we have Sherry is age 22 and is Wes and Tina's daughter. She is a full-time student and lives in a college dormitory. Wes and Tina provide over 50% of her support. Sherry works part-time as a bookkeeper and earned $5,000. So Sherry may be claimed as a dependent by Wes and Tina, as she is considered a qualifying child. She meets the 4 tests of relationship. She is Wes and Tina's child, correct? Her age, she's under the age of 24. Here it lets us know she's 22. She's a full-time student. She has the abode, her temporary presence in the dormitory is treated as living with her parents, as mentioned earlier, and support. She does not provide more than half of her own support. Her gross income is relevant for determining if she's her parents' qualifying relative because she meets the criteria to be a qualifying child. B, so A seems to be correct, but we'll look at the others. In this case, the support test is the only test that must be met. Wes and Tina provide over 50% of her support, so Sherry may be claimed as a dependent because she's a qualifying child. This is incorrect. Sherry is above the age of 19. So therefore, the additional test requirement is that she needs to be under the age of 24 and she is in school full-time. So B is incorrect. C states Sherry may not be claimed as a dependent by Wes and Tina. She is considered a qualifying child and she meets the 4 tests of relationship. She's their child. She's under age 24 and a full-time student. She meets the abode test and support, but it says she fails the gross income test because her gross income exceeds $4,400. So again, because she meets the qualifying child criteria, she is not a qualifying relative. D, Sherry may not be claimed as a dependent because Wes and Tina do not provide 100% of her support. That is incorrect. Again, they need to provide over 50%. So the correct answer is A. Next for C, says same as part C, said Sherry's a part-time student. So based on this information, she's a part-time student. She is above the age of 19. Right? But the requirement is that they need to be a full-time student. So Wes and Tina may claim Sherry in this case. Sherry's student status is irrelevant because she's under the age of 24. No. Although Sherry's part-time student makes her a qualifying child, she may not be claimed as a dependent because Wes and Tina do not provide 100% of the support. Incorrect. C, Wes and Tina may claim Sherry in this case. Sherry's part-time student status makes her exempt from the gross income test. That is incorrect. D, under these facts, Sherry would not be eligible to be claimed as a dependent because she's not a qualifying child. She fails the age test, correct? She is 22. She's above the age of 19. And yes, she is under the age of 24, but she is not in school full time. And she cannot be a qualifying relative because she fails the gross income test. She earned more than $4,400 in 2022 and more than $4,700 in 2023. So therefore, D is the correct answer. And this brings us to the last question. So it says, Granny, age 82, is Tina's grandmother and lives with Wes and Tina. During the current year, Granny's only source of income was her Social Security of $12,000. The Social Security is wholly tax exempt in this situation. Granny uses her income to pay for 40% of her total support. Wes and Tina provide the remainder of Granny's support. So here it says Granny may be claimed as a dependent. Granny is not a qualifying child because she fails the age test, obviously. However, Granny meets all the requirements to be a qualifying relative of Wes and Tina. She meets the relationship test. She is an ancestor of Tina. She meets the gross income test because her gross income is zero. Social Security taxes are wholly exempt. And 3, she meets the support test because Wes and Tina provide 60% of her support. And 4, she's not a qualifying child. So A appears to be the correct answer. B says Granny may not be claimed as a dependent because she is not a qualifying child or qualifying relative. She does not meet the 3 tests of relationship, gross income, and support. This is incorrect. C, Granny may be claimed by Wes and Tina as she's considered a qualifying relative. She meets the 4 tests of relationship, age, abode, and support. Her gross income is not relevant. That is not true. Gross income is relevant when someone is considered a qualifying relative, but gross income is not relative when we are dealing with a qualifying child. D, Granny may not be claimed as a dependent if she fails the gross income. Her income from Social Security exceeds the limit of $4,400. So as it says here, Social Security is tax exempt. So therefore, A is our correct answer. All right. So one of the other key things, in addition to determining whether or not an individual is a dependent, is you need to be able to determine the correct filing status. So here we have, for the following independent situations, determine the filing status for the years in question. All individuals are U.S. citizens. So here it asks, what is Celia's filing status for 2020, 2021, 2022, and 2023? So it states, Wayne and Celia had been married for 24 years before Wayne died in an auto accident in 2020. Celia and her son, Wally, aged 21 in 2020, continued to live at home through 2023. Wally worked part-time, earning $5,000 each year, and attended the university on a part-time basis. Celia provided more than 50% of Wally's support for all 4 years. What is Celia's filing status for 2020, 21, 22, and 23? So after the taxable income is computed, the next step is to determine the gross tax. And in order to determine the gross tax, there is an important implication on the individual's filing status. So there are 7 tax brackets, as we discussed: 10, 12, 22, 24, 32, 35, and 37%. And these rates are progressive, as we mentioned. And the way in which an individual is taxed is ultimately dependent on their filing status, whether they are single, married filing jointly, married filing separately, a head of household, or a surviving spouse. So here in this case, we see that Wayne and Celia, they were married, right? But then Wayne passed away. So essentially what happens is that when an individual passes away, the couple, or the individual rather, is treated as married filing joint for the entire year. So in 2022, the tax status for Celia would be married filing joint. And there's a special provision as it relates to filing statuses for a surviving spouse. So a widow or a widower, they can file a joint return for the year in which his or her spouse dies if the widow or widower does not remarry, right? And for 2 years after the year of death, the widow or widower can file as a surviving spouse, but that's only if they meet specific conditions. The surviving spouse sometimes is referred to as qualifying widow or widower. They must, first and foremost, they should not have remarried as of the end of the year in which the surviving spouse status is claimed. They have to be a U.S. citizen or resident. They have to qualify to file a joint return in the year of death. And lastly, they have at least one dependent son or daughter that lives at home during the entire year, and the taxpayer must pay over half of the expenses, right? So a dependent son or daughter. So in this case, they have a child, and his name is Wally. So Wally's age 21. And we look at the qualifying child and the qualifying relative rule. So we see here for the qualifying child, we know that Wally is not going to qualify. Why? He's above the age of 19 and he's under the age of 24. However, he's not in school full time. So therefore, he cannot be a qualifying child and he cannot be a qualifying relative because he earned $5,000 each year. He earned more than $4,400 for 2022 and more than $4,700 for 2023. So therefore, Celia would need to file single for 2021, single for 2022, and single for 2023. Here it says, Juanita is an unmarried parent who maintained a household for her unmarried son, Josh, age 19. Josh worked full-time and earned $16,000. Juanita provided approximately 40% of Josh's support, but provided all the expenses of maintaining the household. What is Juanita's filing status? So again, we can see how determining whether an individual is a qualifying child or qualifying relative, if it has an impact on the filing status. Here, Josh, he's age 19. But he worked full-time. He's not in school. So therefore, she also only provided 40% of the support. Juanita is considered single. This brings us to the last part question. So here we have, what is Gertrude's filing status, assuming she was still legally married? So it says Gomer and Gertrude are married and have one dependent son. In April, Gomer left Gertrude a note informing her that he needed his freedom and he was leaving her. As of December, Gertrude had not seen nor heard a word from Gomer since April. Gertrude fully supported her son and completely maintained the house. What is Gertrude's filing status, assuming she was still legally married? So as a married individual, they might be unable to file jointly with his or her spouse because the spouse had deserted the individual. So generally, married individuals, they have two options. Either they file jointly or they file separately, right? But there's a special rule called the abandoned spouse rule, right? So with the abandoned spouse rule, Congress, they essentially provided a relief for taxpayers in a specific situation where if they didn't have this rule, then a spouse who was abandoned, then they would need to pay higher taxes, right? Because married filing separate tax brackets are similar to an individual filing as single. So a married individual, they can claim a head of household status, which has a more favorable tax rate under the following circumstances. First and foremost, they have to live apart from his or her spouse for the last 6 months of the year. The taxpayer has to pay over half of the cost of maintaining a household in which the taxpayer's dependent son or daughter lives for over half of the year, and the taxpayer must be a U.S. citizen or resident. So based on this information, Gertrude has not seen or heard a word from Gomer since April. So for the last 9 months of the year, she was basically alone, taking care of her dependent child. So therefore, Gertrude would be able to take advantage of this special provision and file as head of household. All right, this brings us to our next question. So here it says, Julie, a single taxpayer, has adjusted gross income of 88,000, medical expenses of 13,000, home mortgage interest of 4,250, property taxes of 2,700. So should she itemize or should she claim the standard deduction? So first things first, as we mentioned, there's a from AGI deduction, and the from AGI deduction is the greater of the standard deduction or itemized deductions. So for 2022, it lets us know that she's a single taxpayer. For 2022, the standard deduction is $12,950, and for 2023, it is $13,850. So we'll compare each. So we see there's medical expenses as we deal with our itemized expenses. There's medical expenses, property taxes, and home mortgage interest. So medical expenses, we need to do an additional calculation. Keep that in mind. So that's why it's bolded, and we'll do the calculation down below. So before the property taxes, the information that we'll know, we'll start to input it. So we have property taxes of 2,700. It will be the same for both years. And the mortgage interest would be 4,250 for both years. So now, in order for us to determine our medical expenses is one of those itemized deductions that is subjected to a limitation. So the AGI is 88,000. And there's a limitation. So as it relates to medical expenses, the percentage for the medical floor is 7.5%. So a taxpayer is essentially allowed to deduct any medical expenses that exceeds the AGI floor. So AGI is 88,000. We multiply it by the 7.5%. So therefore, the AGI floor for medical expenses are $6,600. So therefore, Julia is allowed to claim any medical expenses that exceeds $6,600. So therefore, it lets us know total medical expenses were $13,000. So 13,000 minus the AGI floor for medical expenses of 6,600. So therefore, the allowable deductible medical expenses is $6,400. 6,400. You claim for both years. So essentially, add the total medical expenses that are allowed to be deducted, property taxes of 2,700, and the home mortgage interest of 42,000. And that gives us a total of $13,350 for both years. All right, I'm just going to double check our math. 88,000 multiplied by 7.5%, 6,600. Perfect. All right. So based on this information, and we had it here, the medical expenses, which were 13,000, the AGI floor for medical expenses, which was 6,600. So our medical deduction allowed is a 13,000 minus the 6,600. All right, so based on this information, we compare the two. So in 2022, you look at the standard deduction amounts, it lets us know 12,950. So therefore, based on this information, the total itemized deductions All right, let me just make sure that the formula is correct. All right, so based on the calculation, the total itemized deductions represent $13,350. So we start off with our medical expenses. We calculated the medical expense, $6,400. We have our property taxes of $2,700. And we have our mortgage interest of $4,250. So therefore, the total itemized deductions is $13,350. All right. So based on this information, it lets us know that the standard deduction for an unmarried individual is $12,950. So based on this information, if we look at the two, if we compare the total itemized deductions to the total standard deduction, in such case, Julie should itemize. Why? Because it gives her a larger deduction. Keep in mind, when it comes to the from AGI deductions, you essentially take whichever would provide the lower taxable income. So in this case, it would work better in Julie's favor if $13,350 of her income is not taxable compared to only $12,950 not being taxable. So that is for 2020, 2022. However, if we were to compare it to 2023, in 2023, the total itemized deductions remained the same, but the standard deduction increased. So therefore, based on this information, if it were 2023, it would work better in Julie's favor if she took the standard deduction, because the standard deduction is $500 more. So based on 2022, itemized deductions worked better for Julie, but in 2023, the standard deduction would work better for Julie. So when it comes to itemized and standard deduction, you essentially can change it from year to year. Ultimately, it depends on whichever works better in your favor. So for 2022, itemized deductions work better for Julie. And in 2023, the standard deduction would work better for Julie. All right, so we're almost wrapping up question 12. It says, under what circumstances, if any, can a married person file as head of household? So we just covered this. A married person, if otherwise qualified, can claim head of household status if he or she is married to a non-resident alien, or if he or she qualifies as an abandoned spouse. To be an abandoned spouse, the person must have lived apart from his or her spouse for the last 6 months of the year and maintain a household for a qualifying child in which they both live. So A seems to be the correct answer, but we'll see. A married person cannot claim head of household status. This status is only for a single taxpayer that maintains a household for a qualifying child in which they both live. That's not correct. Congress has provided relief for spouses who have been abandoned. A married person, if otherwise qualified, can claim head of household status only in the first year. He or she can be classified as a surviving spouse. This is not true. And it says the taxpayer must maintain a household for at least 9 months of the year. This is not true. They must maintain the house for a dependent son or daughter for over half of the year. So that's not true. A married person, if otherwise qualified, can claim head of household status only if he or she qualifies as an abandoned spouse. To be an abandoned spouse, the person must have lived apart from his or her spouse for at least 9 months of the year and maintain a household for a qualifying child in which they both live. That is incorrect. They must have been apart for at least 6 months of the year. So A is our correct answer. For question 13, taxable income for an individual is generally defined as. So as we know, there's a tax formula, and with the tax formula, we essentially start off with our gross income. From there, we subtract any exclusions, and from there, we get deductions for AGI. And then in order to determine taxable income, the adjusted gross income is reduced by the greater of the standard deduction or itemized deductions, as we saw in the previous problem. So C is our correct answer. So this brings us to our last question. All right, so for our last question, it lets us know the following information relates to two married couples. So begin by computing taxable income for each couple. So we look at the information, we have the Wilsons, we have the Matthews, right? The salary just earned by one spouse is $40,000, the Matthews $135,000. So we start to factor in this information. So for the Wilsons, I'll actually take a screenshot of this so we can input the information side by side. And then we'll look at the difference from 2022 to 2023. All right, so here we have the Wilsons and we have the Matthews. So for the Wilsons, we start off with salary. For the Wilsons, lets us know $40,000 worth of income. For the Matthews, they have salary of $135,000. Then it also lets us know that they have some taxable interest income. So because it's taxable, we obviously report it. For the Wilsons, taxable income of $900, and for the Matthews, $800. So based on this information, we determine the gross income. So we get our calculator. So 40,000 plus 900 for the Wilsons. Their gross income is 40,900. And for the Matthews, their salary of 135,000 plus taxable interest income of 135,800 represents their gross income. So next from there, as we learned, there are some deductible things that can take place. So there are some 4 AGI deductions. And one of those 4 AGI deductions are IRA contributions. So it lets us know here that it is deductible. So we would deduct the IRA contribution. The Wilsons do not have an IRA contribution. However, the Matthews, we minus the 6,000. And based on this information, so we get the gross income. So we start off with total income. We get the gross income. We subtract any 4 AGI deductions. And from there, we get our adjusted gross income. So for the Wilsons, their gross income was 40,900. We subtract nothing. There was no 4 AGI deductions. So therefore, their adjusted gross income is 40,900. For the Matthews, on the other hand, they have gross income of 135,800. We subtract the deductible IRA. So therefore, their adjusted gross income is 129,800. So we determine our adjusted gross income, and then now the next step is the from AGI deduction. And from AGI deduction is essentially the greater of the standard deduction or itemized deductions. So here it lets us know that the Wilsons, their itemized deductions are only $1,000, right? So if we look at the 2022 information, so we'll start off here. And we'll input the information for the Wilsons. And we'll compare it for both years. Their IRA contribution, they don't have any. and the greater of the standard deduction or itemized deductions. So for the Wilsons, their itemized deductions would be $1,000 for 2022. The standard deduction amount would be $25,900. So therefore, in the Wilsons case, it will work better for them to have $25,900 of their income not be taxable. So therefore, their taxable income would be $15,000. For the Wilsons, as we were looking at this information for the 2023 tax year, salary remains the same, interest income remains the same. But what does change is the standard deduction. So for 2023, the standard deduction for a married filing joint couple would essentially be $27,700. And in both cases, the standard deduction works better in the Wilsons' favor because their itemized deductions are only $1,000. So therefore, in 2023, their taxable income would be $13,200. So you essentially get to see the impact from year to year of the standard deduction and how it works, right? So that's for the Wilsons. So in this case, for the Wilsons, it would be $25,900. So we do the math. Taxable income would be $15,000. So now we're looking at it for the Matthews. So for the Matthews, all right, so we'll just make it easier. So for the Matthews, their income is $135,000, taxable interest of $800. Their IRA contribution will be $6,000. So we've already calculated that their adjusted gross income is $129,800. But now we essentially need to factor in, well, does it work better in their favor if they claim itemized deductions or standard deductions? So for 2022, the standard deduction for a married couple, as we see here, would be $25,900. And for the Matthews, their total itemized deductions would be $26,800. So in the Matthews situation, it would work better for them to take the standard deduction because if we compare the two, $26,800 is greater than the standard deduction of $25,900. So therefore, the Matthews would claim itemized deductions of $26,800 in 2022, which would give them taxable income of $103,000. However, using the 2023 standard deduction, $27,700 is greater than their itemized deductions of $26,800. So ultimately, it depends on the standard deduction. So again, as mentioned, as referred or saw in the previous problem, it can change from year to year. So in such case, we're using the 2022 tax rules. So therefore, we would subtract the itemized deductions of $26,800 So 129,800 minus 26,800, that gives us taxable income of $103,000. So this brings us to the last part of the problem. It says, now calculate the 2022 tax due or tax refund for each couple. So as mentioned, when we are dealing with taxes, it's not necessarily that there's a single tax. Think of it as buckets. The certain amount that you earn, it is essentially taxed in that bucket. So for the Wilsons, what I'll do is make this easier so that way we can compare it from year to year. So here we have the Wilsons, and then we have the Matthews. All right. Here we do sum. It's one of the key things when you're using Excel. All right, so here we have the Matthews and here we have the Wilsons. So based on this information here, it lets us know if taxable income is not over 20,550, over 20,550, but over. All right, so we'll start with the Wilsons. So we look at the Wilsons information, we see that their taxable income is $103,000. So we try to find a range. And in here we see their income is over 83,550, but not over 178,150. So based on this information, we see it needs to be calculated as follows. So it would essentially be the tax base has something that might make it a little easier. So the base tax in this case is 9,615. And then it says plus 22% of the excess over 83,515. So in this case, the tax rate is 22%. And the excess taxable income over the limit. So for the Wilsons, their taxable income is 103,000. Hide this so we can see it a bit easier. So their income is 103,000. So the excess taxable income over the limit would be 103,000 minus 83,550. So the excess is 19,450. So therefore, the base tax 9,615 plus the excess taxable income over the limit multiplied by 22%. So therefore, the Wilson's tax liability using the 2022 tax rules would be $13,894. So we have $13,894. And then we view the information. Their withholding was $1,000 $8,300 in this case. So $8,300. So therefore, the amount that is owed, I put it in the wrong place. My apologies. $13,894 minus $8,300. So we worked on the Matthews first. Minus $8,300. Therefore, they have a balance due of $5,594. So this is for the Matthews. So we just calculated it for the Matthews. And then now, if we look at it for the Wilsons, their taxable income was $15,000. So based on the information here, this is if their income is not over $20,550, their taxable income is only $15,000. So therefore, it would simply be 10% of the income. So in such case, the gross tax would be $15,000 multiplied by 10%. Their gross tax would be $1,500. They had withholding of $1,300. So the gross tax would be $1,500. They had a withholding of $1,300. So therefore, the Wilsons owe $200. All right. So key thing to keep in mind is mentioned again when you're using the tax rate schedule. Think of it as buckets. Here we see if taxable income is not over 20,000, 10% of income is taxable. If it falls within the second bucket, they've earned more than 20,550, but less than 83,550. Then there's this minimum tax base. Then you add 12% of the excess. The same thing if they move on to the next bucket, if they've earned over 83,550, but not over 178,150, there's this base. And then you tax the additional amount by the marginal tax, which is 22%. All right, so I hope that this video helps. Again, this covered several questions from chapter 1, which covers an introduction to taxation, and chapter 2, which covers the determination of tax.